Retailers are reporting roughly $45 billion in combined BNPL fees and chargebacks as of 2025, forcing many to drop the service overnight. Because most merchants can't pass BNPL fees on to consumers, they absorb an 8% processing charge on each transaction, plus the cost of customer returns. This mounting burden has pushed major chains to abandon BNPL, triggering confusion for shoppers and lenders alike. The collapse is not just about retailer losses. Consumers are increasingly using BNPL for essentials like groceries, a shift that signals deeper economic stress. Later we'll show how consumers, retailers, and investors each face their own fallout from this unraveling system. The $800 billion debt bubble. As of 2025, total outstanding BNPL balances soar to about $800 billion, double from just 2 years prior and spread across over 100 million users projected by 2027. The sheer speed and scale of this growth have caught both providers and regulators off guard. What began as a niche payment option has become a major source of consumer debt, outpacing even the most optimistic forecasts from the industry's early years. Unlike traditional credit cards, which offer flexible repayment over months or even years, BNPL loans are intended to be repaid within a much shorter window, usually around 6 weeks. But the reality is that many borrowers are not meeting these deadlines. Research finds BNPL serious delinquency, 90-plus days past due, at a firm with 0.7%, compared to 7.2% for credit cards. While this might seem low, the short-term nature of BNPL loans means that even a small rate of serious delinquency can quickly add up, especially as more users take out overlapping loans. Defaults frequently stretch well beyond the intended 6-week repayment period, with some lingering for 120 days or more. The structure of BNPL makes it easy for users to accumulate debt without realizing the full scope of their obligations. According to the Consumer Financial Protection Bureau, about 63% of BNPL borrowers had simultaneous loans at some point during the year, often averaging around 1 active loan per day. The average number of BNPL loan originations per borrower climbed from 8.5 to 9.5 annually. Many users take out loans across multiple providers, making it difficult for lenders to assess the true risk of overextension. What looks like a manageable payment for a single purchase quickly becomes overwhelming when stacked alongside several others. The composition of this debt bubble is shaped by 3 main factors. First, BNPL approval rates have jumped to 79%, thanks in part to the growing use of counteroffers. Lenders may offer a lower credit amount or require a higher down payment rather than reject an applicant outright. Second, the bulk of BNPL originations, about 61%, go to subprime or deep subprime borrowers, a group with limited access to traditional credit and higher default risk. Third, merchant incentives play a major role. Retailers pay BNPL providers fees of 5 to 8% per transaction, much higher than the 1.5 to 3.5% charged by credit cards, in exchange for the promise of higher sales and conversion rates. Major BNPL firms like Klarna and Afterpay built their growth on the assumption that most users would pay on time. However, recent data tells a different story. Klarna's Q1 2025 earnings revealed a 17% year-over-year increase in consumer credit losses. A firm reported that 38% of its 2024 loans were issued to borrowers already holding 3 or more active BNPL arrangements. Many delinquent users miss payments across multiple providers, compounding the risk for both lenders and consumers. The $800 billion in outstanding BNPL debt is not evenly distributed. Over 60% of this debt is held by consumers under the age of 35, most of whom have limited savings to absorb financial shocks. The risk is amplified for those who also carry credit card balances, student loans, or auto payments. Each new BNPL commitment makes their overall financial position more precarious, increasing the likelihood of missed payments and cascading defaults. Investor enthusiasm fueled the rapid expansion of the BNPL industry, but as losses mount and risks become clearer, funding has dried up. Venture capital investment in BNPL startups has dropped 82% since 2022, signaling a sharp reversal in sentiment. Retailers, too, are rethinking their reliance on these services, as higher fees and increased return rates among BNPL customers eat into profits. This debt bubble did not form overnight. It grew as more consumers and businesses embraced the convenience of splitting payments, often underestimating the long-term consequences. The $800 billion milestone is a visible marker of an underlying problem. Products designed for short-term, responsible use have instead become vehicles for chronic overextension. While the financial risks are clear, the reasons so many people continue to turn to BNPL are rooted in something less tangible. The next challenge is understanding why this payment model has proven so irresistible, even in the face of mounting debt. The psychological trap of BNPL. The psychological mechanisms built into buy now, pay later services are central to their rapid rise. These platforms are engineered to sidestep the hesitation that usually comes with spending, especially on larger purchases. By dividing payments into smaller, timed installments, BNPL reduces the psychological cost of each purchase, a phenomenon behavioral economists call the pain of paying effect. Instead of confronting the full price up front, shoppers see a much lower immediate outlay, which makes the decision to buy feel less weighty. This structure isn't just clever, it's effective. Studies found BNPL adoption boosts purchase likelihood by up to 26% and raises per transaction spending by about 10%, combining to a 30% lift in discretionary outlays. Harvard Business Review research confirms that after adopting BNPL, users per purchase amounts rise around 10% and overall discretionary spend jumps nearly 30%. The reason is rooted in how the brain perceives numbers. Breaking a $100 item into 4 $25 payments triggers the numerosity effect, where smaller, more frequent charges feel less significant than a single large one. This makes it easier for consumers to justify spending more than they originally intended. Actual spending patterns underline these psychological effects. BNPL users show credit card utilization rates between 60% and 66%, nearly double the 34% average among non-users. This means that many people are layering BNPL debt on top of already high credit card balances, increasing their risk of financial distress. The installment model doesn't just spread out payments, it also spreads out the awareness of debt, making it harder for users to track their total obligations. The way BNPL presents payment options further shapes behavior. Seeing $25 today, rather than $100 now, prompts a different mental calculation. The smaller initial payment activates a sense of reward, while the discomfort of paying the full amount is postponed. Over time, this conditions users to associate BNPL with positive feelings, even as their financial commitments quietly add up. In a LendingTree survey, 41% of BNPL users reported making at least one late payment in the past year, suggesting that the ease of entry often leads to repayment problems. BNPL also influences what people buy. Data shows that users are more likely to pick premium or name-brand products over budget alternatives. The installment structure removes the immediate financial barrier, nudging consumers toward more expensive choices. This effect extends into everyday spending. 25% of BNPL users now use these services for groceries, up from 14% a year earlier. What started as a tool for occasional big-ticket purchases has become a way to manage even routine expenses, increasing the risk of chronic overextension. Household dynamics play a role as well. Married consumers are more likely to use BNPL, likely due to the pressure of managing higher expenses. The flexibility of installment payments can seem like a lifeline when budgeting for a family, but it often leads to a buildup of overlapping obligations across multiple purchases and providers. Late fees are another psychological snare. BNPL companies now generate 38% of their revenue from late fees, up from 22% in 2022. The average delinquent user pays $127 in fees for every $100 borrowed, making missed payments far more costly than they appear at checkout. Yet the initial ease and perceived affordability of BNPL keep users coming back, even as costs mount. The design of BNPL platforms maximizes impulse buying by removing the natural pause for consideration that comes with traditional credit applications. Instant approvals at checkout, combined with the lowered pain of paying, encourage quick decisions and make it easy to lose track of multiple outstanding payments. Many users fail to account for upcoming installments in their budgets, leading to a tangle of simultaneous loans that become difficult to manage. These psychological factors have real consequences. The gap between how BNPL feels in the moment and the reality of repayment obligations is driving a surge in missed payments and delinquencies. As more users struggle to keep up with overlapping debts, the financial risks are becoming impossible to ignore. Record default rates in 2025. Signs of strain are now appearing in the numbers. Klarna, one of the largest BNPL providers, reported a 17% increase in credit losses for the first quarter of 2025, with $136 million written off, an unmistakable signal that more users are falling behind on their obligations. This trend is not isolated. Across the sector, late payments and defaults are rising, reflecting the mounting difficulty borrowers face as they juggle multiple short-term loans. Charge-off rates for BNPL remain lower than those for credit cards, but the trajectory is troubling. In 2022, providers saw charge-offs reach about 1.2% of total BNPL transaction amounts, with serious delinquencies at roughly 0.7% at Affirm, compared to 7.2% for credit cards. Even so, the short-term nature of BNPL loans means that relatively modest default percentages can translate into significant losses as loan volumes balloon. LendingTree's latest survey found that 41% of BNPL users had made at least one late payment in the past year, up from 34% the previous year, underscoring how quickly payment troubles are spreading. The structure of BNPL products creates unique challenges when borrowers fall behind. Most providers define a loan as in default once it is 120 days past due, and lenders typically write off the balance about 6 weeks after that window. This means that many users are in limbo for months, accruing late fees and penalties as their financial situation worsens. The CFPB reports that the average delinquent BNPL loan now sits unpaid for nearly 5 months before being written off. During this period, late fees add up quickly, increasing the burden on already struggling borrowers and raising the cost of default for providers. Late fees have become a substantial revenue stream for BNPL companies. In 2025, late fees accounted for 38% of total BNPL provider revenue, up from 22% just 2 years earlier. This shift signals a growing dependence on borrowers missing payments, rather than on the core lending business itself. As more users slip into delinquency, providers collect more in penalties, even as they absorb higher losses from charge-offs. The incentive structure rewards providers when users fail to repay on time, creating a conflict of interest that delays meaningful reforms to approval standards and risk management. Economic conditions have made repayment even harder. Persistent inflation and an uncertain job market have pushed more consumers to use BNPL for essential expenses, not just discretionary purchases. LendingTree found that 25% of BNPL users now use the service to buy groceries, up sharply from 14% the previous year. This shift means that missed payments are increasingly tied to necessities, not luxuries, and the fallout from defaults is more severe for household budgets. BNPL users tend to carry other unsecured debts as well, including credit cards, personal loans, and student loans. When money runs short, borrowers often prioritize certain bills over others, letting some BNPL payments lapse while attempting to stay current elsewhere. The easy access to multiple simultaneous BNPL loans, often without thorough checks on overall debt load, compounds the risk. Many users maintain several active loans at once, and the average default now involves $387 in principal spread across 3 separate BNPL arrangements. Demographic trends reveal that younger consumers are especially vulnerable. Millennials and Gen Z account for nearly 2/3 of BNPL defaults, despite making up about half of all users. Lower incomes, less financial experience, and higher reliance on installment credit contribute to this imbalance. Defaults are also concentrated in regions with weaker job markets and higher living costs, including urban centers and parts of the South, where economic hardship is more acute. As losses mount, some providers have begun tightening their lending standards, but these changes come after years of rapid expansion and easy approvals. The true scale of the default problem may not be fully visible yet, as many recent loans have not aged enough to show up in default statistics. Meanwhile, the sector's growing reliance on late fees and the drawn-out process before loans are written off mean that both borrowers and lenders are left in a prolonged state of uncertainty. These rising losses and persistent payment problems are forcing a reckoning across the industry. Providers, once eager to partner with retailers, now face mounting pressure as the costs of delinquency and default ripple outward. The retailer reckoning. For retailers, the sharp rise in BNPL-related costs has triggered a fundamental reassessment of their payment strategies. The $45 billion in combined BNPL fees and chargebacks that hit the sector in 2024 set off a wave of exits by major chains. Target and Best Buy were among the first to remove BNPL options from both online and physical checkouts, a move that signaled a broader shift across the industry. Internal reviews at these companies showed that the short-term sales lift from BNPL could not offset the mounting long-term losses caused by high fees, chargebacks, and increased operational complexity. The economics behind these decisions are stark. BNPL providers now charge merchants up to 8% per transaction, far above the typical 2 to 3% credit card processing fee. For retailers operating with profit margins in the 3 to 5% range, this fee structure alone can erase any hope of profitability on BNPL sales. When chargebacks are factored in, the math becomes unworkable. A $100 sale processed through BNPL leaves just $92 before accounting for product costs and overhead, and any chargeback pushes the transaction firmly into the red. Retail contracts typically prohibit merchants from passing BNPL fees directly to consumers. This forces stores into a difficult position. Either absorb the loss or raise prices for all customers, regardless of payment method. Many retailers have responded by quietly increasing base prices 4 to 6% across the board to compensate for BNPL-related losses, making everyday goods more expensive even for those paying upfront. The chargeback problem is rooted in the way BNPL transactions are structured. When a customer defaults, the retailer, not the BNPL provider, bears the loss for merchandise that's already been shipped. This arrangement effectively turns merchants into unsecured lenders without their consent. The $45 billion in chargebacks represents goods delivered but never paid for in full, with retailers left with little recourse for recovery. Small businesses feel these effects even more acutely. While major chains can sometimes negotiate slightly lower fees, independent retailers often pay the full 8% with no volume discounts. For a small shop with a 10% profit margin, a single BNPL transaction can wipe out most of the earnings on that sale. Many report that BNPL fees now consume more than half of their total margin on these transactions. Return rates compound the financial strain. Retail analysts report that BNPL customers return items 18 to 22% more often than those using other payment methods. Each return means the retailer pays the BNPL fee but loses the sale, amplifying losses. This has led some stores to conclude that their entire BNPL customer base is unprofitable when all factors are considered. The shift in BNPL use toward essentials like groceries has further complicated the picture. Nearly half of BNPL transaction volume now goes toward food and other necessities. When customers default on these purchases, the retailer has no way to recover the cost, and the risk profile for these transactions is even higher than for discretionary items. Most merchant agreements also prevent stores from directing customers toward less costly payment methods. Even suggesting that a shopper use a credit card instead of BNPL can violate contract terms. This restriction leaves frontline employees unable to help customers make more sustainable choices, even as they watch profit margins erode. Attempts to limit BNPL exposure, such as lowering approval thresholds or capping repeat usage, have had little effect. The core issue remains. BNPL customers, as a group, have become less reliable, and the risk of default has outpaced any benefits from increased sales volume. Meanwhile, inventory planning has suffered, with retailers left holding excess premium stock after BNPL-driven purchases are returned or defaulted on. BNPL's fee model also creates a misalignment of incentives. Providers collect their fees from merchants up front, regardless of whether customers repay. This structure encourages loose underwriting and shifts nearly all the risk onto retailers. As a result, merchants have shouldered the financial consequences of BNPL's rapid expansion, while providers remain insulated from direct losses. Labor costs tied to BNPL disputes and returns add another layer of expense. Retailers must dedicate staff to handle chargeback claims and process returned merchandise. For some, the added workload means spending several dollars in labor per BNPL transaction, further eroding any remaining profit. As more retailers exit BNPL partnerships, the system becomes riskier for those who remain. The customer pool skews toward higher-risk users, defaults accelerate, and the 8% merchant fees become even harder to justify. What began as a promising tool for boosting sales has become a costly liability that many stores can no longer afford. Mounting financial pressure has left retailers demanding changes to how BNPL operates. The industry's reliance on shifting risk to merchants, paired with unchecked growth, has brought these issues to a head. With losses rising and confidence in the model eroding, outside intervention is starting to reshape the landscape. Regulatory crackdowns begin. Regulators took notice as BNPL's unchecked expansion began straining both consumers and merchants. In 2024, the Consumer Financial Protection Bureau moved decisively, issuing an interpretive rule that redefined BNPL providers as credit card issuers under the Truth in Lending Act and Regulation Z. This change forced BNPL firms to overhaul their compliance structures almost overnight. They are now required to provide detailed billing statements, investigate customer disputes, and process refunds for returns. Responsibilities that had long applied to credit card companies, but not to the fast-growing BNPL sector. This regulatory shift was not limited to federal action. Several states introduced new licensing requirements for BNPL providers, mirroring the strict oversight applied to payday lenders. Some states imposed interest rate caps that effectively limited the high late fees many BNPL companies relied on. These state-level moves created a patchwork of compliance obligations, making it more expensive and complicated for BNPL firms to operate across the country. The CFPB's new rules directly addressed gaps that had fueled BNPL's rapid growth. Before these changes, providers could approve loans with minimal credit checks, leaving them, and their customers, vulnerable to overextension. The lack of reporting to credit bureaus allowed borrowers to stack multiple BNPL loans across different platforms without any lender seeing the full picture. Now, BNPL activity appears on credit reports, giving providers a clearer view of a borrower's obligations and curbing the practice of taking out several loans at once. Early data suggests this has already reduced the frequency of loan stacking, as lenders become less willing to approve new credit for heavily indebted applicants. Dispute resolution requirements have also shifted the financial burden. Previously, when a customer challenged a transaction, retailers often absorbed the cost. Under the new rules, BNPL providers must investigate and resolve disputes themselves, including refunding customers when appropriate. This has forced companies to invest in new back-office systems and customer service infrastructure, increasing their operating costs and prompting a tightening of approval standards. The introduction of mandatory billing statements and clearer disclosures has altered the customer experience. Consumers now receive monthly summaries of their BNPL activity, making it harder to lose track of outstanding debts. Merchants must provide clear receipts that spell out payment terms whenever a purchase uses BNPL financing. Many retailers have had to update point-of-sale systems and train staff to comply with these new requirements. Capital requirements are another looming challenge. Unlike traditional lenders, most BNPL companies have not maintained substantial cash reserves. Under the new regulatory regime, they may need to raise significant amounts of capital or sharply reduce lending volumes to meet minimum standards. This will likely constrain growth and could force some smaller providers out of the market altogether. Internationally, similar crackdowns have taken shape. The UK and Australia have both moved to classify BNPL as a form of regulated credit, introducing requirements for credit checks, dispute resolution, and transparency in marketing. These global trends suggest that the era of regulatory leniency for BNPL is ending, and providers worldwide must adapt to a much stricter operating environment. The regulatory changes have already started to reshape consumer behavior and the BNPL business model. Approval rates have dropped as credit checks become standard, and average loan amounts have decreased. The removal of regulatory arbitrage means BNPL can no longer compete with credit cards simply by sidestepping compliance costs. Providers now face the same scrutiny and obligations as traditional lenders, erasing what had been a core competitive advantage. For BNPL companies, these new rules have exposed how unprepared many were for the demands of regulated financial services. The scramble to build compliance departments, risk management systems, and proper accounting controls has added to their expenses, deepening recent financial losses. As these regulatory realities take hold, the consequences for the sector are becoming more visible. The next signs of stress are appearing in company earnings, workforce reductions, and investor sentiment, evidence that the new rules are reshaping the industry's prospects in real time. The death spiral of BNPL companies. The unraveling of the buy now pay later sector is most visible in the fortunes of its biggest players. Affirm shares have plummeted nearly 80% since early 2021, a sharp reversal from the optimism that once surrounded the company. For several quarters, Affirm's revenue continued to climb, but losses outpaced any gains. Investors who once viewed BNPL as the next evolution in consumer credit now question whether the business model can deliver sustainable profits at all. Affirm's latest reports show defaults growing faster than new accounts, exposing the core weakness of relying on rapid expansion without strong risk controls. Klarna's recent moves further highlight the instability within the sector. After reporting a 17% year-over-year increase in credit losses to $136 million in the first quarter of 2025, Klarna cut 35% of its staff and postponed its highly anticipated IPO. The company's unpaid loan ratio edged up from 0.51% to 0.54% in just one quarter. A small percentage change that still translates to millions in additional losses when loan volumes are this high. The IPO delay reflects the market's skepticism about the long-term prospects of BNPL. Firms and private investors have had to adjust expectations for returns as valuations fall. Block's experience with Afterpay illustrates the scale of losses that can result from misjudged risk. Block recorded a $3.4 billion write-down, reflecting Afterpay's underperformance and the rapid deterioration of its loan book. The acquisition, once seen as a strategic move to reach younger consumers, quickly became a liability as default rates climbed and the cost of managing bad debt outstripped any potential gains. The write-down is a clear acknowledgement that the risks inherent in the BNPL model were underestimated. At the heart of these struggles is a set of flawed assumptions. The idea that short-term, small-dollar loans could avoid the pitfalls of traditional consumer lending did not hold up under real-world economic stress. BNPL companies, eager to grow, prioritized easy approvals and volume over careful assessment of borrowers' ability to repay. This approach drove up default rates and left firms exposed when borrowers fell behind on payments. Merchant fees, which were supposed to provide a cushion against risk, proved insufficient as losses mounted and return rates increased. Attempts to use technology and behavioral insights to manage risk fell short. Automated underwriting and AI-driven credit models failed to anticipate how quickly financial stress could spread among borrowers. As more users took on overlapping BNPL loans, the risk of cascading defaults increased, and the cost of servicing these loans rose sharply. Companies discovered that the economics of unsecured lending are unforgiving. Even small increases in default rates can erase the profits from thousands of successful transactions. The rapid growth that once fueled soaring valuations has now become a liability. BNPL firms depended on continuous expansion to cover losses and justify their business models. But as regulatory scrutiny increases and lenders tighten approval standards, growth has slowed. Each effort to improve credit quality, by raising standards or reducing loan volume, cuts into revenue, while loosening standards only brings higher losses. The industry is caught in a cycle where every adjustment creates new problems. This death spiral is not just about company valuations or quarterly losses. It reflects a fundamental mismatch between the promise of easy, flexible credit and the realities of consumer finance. The belief that BNPL could sidestep the risks of traditional lending has been proven wrong as defaults rise and profitability remains elusive. Investors, regulators, and companies themselves now face the consequences of building a sector on assumptions that no longer hold. The BNPL collapse has forced a closer look at how risk is managed in consumer lending. The differences between BNPL and more established forms of credit are becoming harder to comparison, especially as the fallout between buy now pay later services and traditional credit cards reveal why their outcomes have diverged so sharply. While both products allow consumers to defer payment, the underlying risk management and user profiles are fundamentally different. Credit card companies use detailed credit checks, sophisticated scoring models, and ongoing account monitoring to limit overextension. They factor in payment history, existing debts, and recent credit applications before issuing new credit or increasing limits. This approach is designed to identify risk early and contain it, especially for borrowers who might already be financially stretched. BNPL providers, in contrast, historically approved a much higher share of applicants with far less scrutiny. CFPB data shows BNPL lenders approved 79% of applications in 2022, a figure that includes counteroffers with lower amounts or higher down payments. Many BNPL users have subprime or deep subprime credit scores, borrowers who would not qualify for most traditional credit cards. This difference in screening standards created a borrower pool with a higher risk of default and financial distress. While credit cards typically approve 20 to 40% of prime applicants, BNPL's broad acceptance fueled rapid growth, but at the cost of higher exposure to loss. The numbers reflect these choices. By late 2024, 90-plus day delinquency rates on credit cards stood at 7.2%, while Affirm, one of the largest BNPL providers, reported serious delinquencies at just 0.7%. At first glance, this might suggest BNPL is safer, but the context matters. Credit card balances are far larger and more persistent, while BNPL loans are short-term and often repaid automatically. Many BNPL users also carry higher balances on other forms of unsecured credit, including $871 more in credit card debt and $5,734 more in student loans than non-BNPL users, according to CFPB research. This pattern signals that BNPL often adds to, rather than replaces, existing debt. A key structural difference is how the two products handle borrowing limits. Credit card issuers set clear limits and routinely adjust them based on account activity and risk. If a cardholder's behavior signals trouble, limits are lowered or accounts are closed. BNPL platforms historically operated in isolation, with no central limit or visibility into a user's obligations across multiple providers. In 2022, 63% of BNPL users had multiple active loans, and 33% had loans with several different BNPL firms at the same time. This stacking behavior allowed debt to accumulate quickly, often without the borrower or lender realizing the full extent of the risk. The consequences of missed payments also differ. Credit cards report delinquencies to credit bureaus after 30 days, which can swiftly impact a user's credit score. Until recently, BNPL missed payments were invisible to credit reports, allowing users to accumulate debt without immediate penalty. With new regulations, BNPL activity is now reported, and the impact on credit scores is becoming more apparent. This shift is exposing how much hidden debt some users carried, and is beginning to reign in the most extreme cases of overextension. Interest and fee structures offer another point of contrast. Credit cards charge interest on unpaid balances, incentivizing users to pay off debt quickly. BNPL services usually offer interest-free installments, but impose late fees if payments are missed. These late fees can add up fast, especially as users juggle multiple loans across different platforms. The perceived simplicity of BNPL, split payments, no interest if paid on time, can mask the risk of spiraling debt when several obligations come due at once. Fraud and dispute resolution also separate the two products. Credit card networks have standardized, regulated procedures for handling disputes and fraud, with clear protections for both merchants and consumers. BNPL providers often left merchants responsible for resolving disputes and absorbing losses from chargebacks, which contributed to the recent surge in retailer exits. Rewards and incentives further shape consumer behavior. Credit cards typically encourage prompt repayment by offering points or cash back for full monthly payments. BNPL, by contrast, normalizes spreading payments out, with no comparable rewards for clearing debt early. This difference subtly shifts how users approach their obligations. As regulators require BNPL providers to adopt credit checks and report activity to bureaus, the lines between the two products are blurring. The core distinction remains. Credit cards built systems to monitor and contain risk, while BNPL prioritized accessibility and rapid growth, often at the expense of sustainability. These differences are now reshaping how consumers use BNPL, especially as financial pressures change the types of purchases people make. The grocery store phenomenon. A striking shift has emerged in how consumers use buy now, pay later services. More people are relying on BNPL to pay for groceries and other essentials, not just occasional splurges. LendingTree's 2025 survey found that 25% of respondents used BNPL for groceries, up from 14% the previous year. This trend signals a move away from one-time, discretionary purchases toward using installment payments to manage the basics of everyday life. This change is closely tied to the rising cost of living. As prices at supermarkets increase, Walmart, for example, has implemented several price hikes. Households are using BNPL to bridge the gap between income and expenses. Unlike the original pitch of BNPL as a way to spread out the cost of a new phone or pair of shoes, the service is now a tool for covering weekly food bills. The amounts involved might seem modest, but when BNPL is used for recurring needs like groceries, the debt can quickly pile up. Each new grocery trip can mean a new loan, and for many, these obligations overlap as previous balances remain unpaid. The risks of using BNPL for necessities differ from those tied to discretionary spending. Groceries are non-returnable, perishable, and essential. If a borrower defaults, there's nothing for the lender or retailer to recover. This makes the losses on grocery BNPL loans total write-offs. LendingTree data shows that default rates on grocery-related BNPL loans are significantly higher than the average across all categories, reflecting the financial strain on users who are already struggling to cover basic expenses. The structure of BNPL payments compounds the problem. Installments for grocery loans become just another fixed cost, competing with rent, utilities, and other pressing bills. For households living paycheck to paycheck, missing a payment triggers late fees that can rapidly turn a manageable balance into a much larger burden. Many users report falling behind not because of a single large purchase, but because multiple small loans accumulate faster than they can be paid off. This pattern is especially pronounced among younger consumers. Millennials and Gen Z make up a disproportionate share of those using BNPL for groceries, according to survey data. These age groups often face tighter budgets and less access to traditional credit, making installment plans an appealing, if risky, way to keep food on the table. Many report turning to BNPL during the last week before payday, when cash runs lowest and other options are exhausted. Retailers are responding to these trends in different ways. Some supermarkets have started to limit BNPL options or require larger down payments for grocery purchases, hoping to reduce their exposure to losses. Since groceries can't be returned or resold, chargebacks from defaults represent a total loss for the store. The economics of BNPL for essentials are fundamentally different from those for big-ticket items, and many merchants are reconsidering whether the service is sustainable for everyday goods. The psychological impact of financing groceries is also distinct. Users often express discomfort or embarrassment about relying on BNPL for food, a feeling not typically associated with using BNPL for more aspirational purchases. This emotional strain can lead to avoidance behaviors, delaying payments, ignoring reminders, and allowing fees to accumulate. Providers report that delinquent grocery BNPL users are less likely to communicate or seek help compared to those with other types of loans. Patterns in BNPL grocery use reveal deeper budget problems. Usage spikes at predictable times. The end of the month, when benefits or paychecks run out, and before major holidays, when household food costs rise. These clusters suggest that installment plans are not a solution for one-time emergencies, but a sign of recurring shortfalls in household finances. Differences in how people use BNPL for groceries also reflect broader economic inequalities. Urban consumers facing higher food prices tend to borrow more per trip than rural shoppers. Single-parent households and those with limited savings are overrepresented among BNPL grocery users, highlighting the service's growing role as a last resort for those with the fewest options. As BNPL becomes increasingly woven into the fabric of essential spending, the risks of debt spiraling out of control grow. Each new grocery loan adds to a web of overlapping obligations, making it harder for users to keep track of what they owe. This mounting complexity sets the stage for a new and more dangerous pattern of borrowing: the debt stacking crisis. Debt stacking has become one of the most troubling features of the BNPL landscape. Instead of managing a single short-term installment plan, many consumers now juggle multiple BNPL loans at once, often across different providers and for both essentials and non-essentials. This pattern is not just a sign of convenience. It's a clear indicator of financial distress and a warning that the system's design encourages overextension. The prevalence of debt stacking is well documented. In both 2021 and 2022, 63% of BNPL borrowers held simultaneous loans at some point during the year. The complexity deepens as nearly a third, 33%, maintained loans with more than one BNPL provider at the same time, according to CFPB research. This means that a significant share of users must keep track of several payment schedules, due dates, and terms, all while trying to avoid missed payments and late fees. For many, the challenge is simply too great, and the risk of slipping into delinquency rises with every new loan. The frequency of borrowing has also climbed. The average number of BNPL originations per consumer rose from 8.5 in 2021 to 9.5 in 2022. Heavy users, who represent about 20% of all borrowers, originated more than 12 loans in a single year. The median for this group was 23 loans annually, an extraordinary level of activity that signals deep reliance on BNPL as a source of liquidity. These heavy users are disproportionately exposed to repayment trouble, as their obligations overlap and compound. This stacking behavior is often a direct response to shrinking access to traditional credit. Data shows that credit card utilization rates spike in the year before a consumer first turns to BNPL, reaching between 60% and 66% compared to just 34% for those who never use BNPL. When card limits are maxed out or new credit is unavailable, BNPL becomes the fallback. Rather than reducing their overall debt, borrowers simply layer BNPL on top of existing obligations, worsening their financial position. Managing multiple BNPL loans is not straightforward. Each provider sets its own repayment schedule, some bi-weekly, others monthly, making it easy for users to lose track of which payments are due when. As the number of loans increases, so does the likelihood of missing a payment. Late fees accumulate quickly, and the cycle of borrowing to cover old debts can begin. For those who fall behind, the consequences are severe. Delinquent users can pay more than $1 in late fees for every dollar borrowed, according to industry data. Historically, BNPL providers operated in silos, with little to no sharing of customer data. Borrowers could take out loans from multiple platforms without any one provider seeing the full picture of their indebtedness. Some consumers even spread their loans intentionally, hoping to avoid detection until their finances collapsed under the weight of overlapping obligations. Only recently have regulations begun to require credit reporting, making it harder but not impossible to stack debt across providers. Demographics play a role in who is most affected. Younger consumers, particularly those under 35, are more likely to engage in stacking. Many lack the experience or financial literacy to recognize the risks until they are already overwhelmed. As missed payments pile up, credit scores drop, and the prospect of recovery fades. The psychological effect is powerful. Many users believe they can catch up with future income, underestimating how quickly small debts can become unmanageable when multiplied across providers. Retail practices and marketing add fuel to the fire. Instant approvals and buy now messaging make it easy to take on new loans with little consideration for the bigger picture. Some users take out loans for non-essential purchases, then resort to additional BNPL financing for groceries or bills when cash runs short. The result is a cycle where a growing share of monthly income is devoted to BNPL repayments, crowding out essential expenses and pushing borrowers closer to default. The consequences extend beyond individual users. As defaults rise and stacked debts become uncollectible, BNPL providers and retailers are forced to recognize that the risks of unchecked borrowing cannot be ignored. The same aggressive growth tactics that once drove the sector's expansion are now exposing its fundamental vulnerabilities. This mounting evidence of instability has started to influence the broader market's perception of BNPL. The sector's ability to attract capital and maintain investor confidence is now in question, as the true costs of debt stacking come into focus. The investor retreat. Investor support for the buy now, pay later sector has evaporated at a pace few expected. Over the past 2 years, venture capital funding for BNPL startups has dropped by 82%, a steep reversal from the frenzy of earlier rounds. What was once a magnet for billions in fresh capital is now met with hesitation, as investors weigh the risks of rising defaults and a tightening regulatory environment. The days when growth metrics alone could justify sky-high valuations have ended, and the industry's ability to attract new funding has been severely compromised. One of the most telling moments came when SoftBank, long known for bold bets on technology, wrote off its entire $1.5 billion investment in Klarna. This decision followed Klarna's valuation collapse from $45.6 billion to just $6.7 billion in a year and a half. Such a dramatic markdown from a major backer sent a clear signal to the rest of the market. Confidence in BNPL's long-term prospects is gone. Other BNPL companies have seen similar declines, with average valuations falling 90% from their peaks. Affirm, for example, traded at $176 per share in 2021, but now struggles to stay above $30. These declines are not just market noise. They reflect a deeper reassessment of the sector's business fundamentals. The sudden drop in funding has forced BNPL companies to confront difficult choices. Many had built their operations around the assumption of continuous cash infusions to cover losses while expanding. As the flow of capital dried up, providers like Klarna responded with major layoffs, cutting 35% of staff. Affirm and others slashed marketing budgets and pulled back on aggressive customer acquisition. Smaller firms, unable to secure bridge funding, have exited the market entirely. The focus has shifted from rapid expansion to basic survival, as firms scramble to extend their runway in the face of shrinking resources. Public markets have been equally unforgiving. The sole BNPL-focused exchange-traded fund has lost over 80% of its value since launch, lagging far behind broader fintech indices. Analyst ratings have turned sharply negative, with many downgrading BNPL stocks and questioning whether the sector can ever achieve sustainable profitability. The narrative has changed from one of boundless potential to one of existential risk. Early venture investors who exited at the top locked in gains, but those who held on have absorbed severe losses. Sequoia Capital reportedly sold $1 billion worth of Affirm shares near the peak, while later entrants like Tiger Global now face substantial write-downs. This mismatch between early and late investors complicates future fundraising, as new capital comes with tougher terms and existing shareholders see their stakes diluted. The collapse in valuations has exposed the flawed assumptions that once drove the sector's growth. Investors previously valued BNPL companies based on user numbers and transaction volumes, largely ignoring credit quality and actual profit margins. As default rates climbed and regulatory costs increased, the limits of this approach became clear. Now, investors insist on clear paths to profitability, something few BNPL providers can demonstrate. Private equity firms, which sometimes step in when growth investors pull back, have shown little interest in BNPL. The sector's challenges go beyond temporary setbacks. High default rates, regulatory uncertainty, and intense competition make even distressed valuations look risky. Debt markets have also tightened. Major banks have reduced or restricted warehouse lines that BNPL firms rely on to fund new loans, further constraining their ability to lend and grow. This retreat from all sides has created a feedback loop. As funding dries up, BNPL companies must scale back lending, which slows growth and makes them even less attractive to investors. Without a credible path to profitability, the cycle continues, with each round of cuts reinforcing doubts about the sector's future. The global nature of the pullback is clear. European and Australian BNPL firms have faced even sharper valuation declines amid new regulations. In emerging markets, what once seemed like an opportunity now looks too fraught with risk. The sector-wide repricing shows that this is not an isolated U.S. trend, but a worldwide shift in sentiment. As capital becomes more scarce, BNPL providers are under pressure to fundamentally change their business models. Some investors push for consolidation to reduce competition, while others advocate for new products with higher margins. These changes mark a break from the original promise of simple, low-cost installment plans. For those still in the sector, the immediate challenge is adapting to a world where easy funding is no longer available. The next pressure point is already emerging, as companies look for new revenue streams to offset shrinking investment and rising losses. The hidden costs to consumers. For consumers, the real costs of buy now pay later services often remain hidden until it's too late. While these platforms promote interest-free payments and easy budgeting, the bulk of their revenue now comes from late fees and penalties. As of 2025, late fees make up 38% of BNPL provider revenue, a sharp rise from 22% just a few years prior. This growing reliance on penalty income means that many companies now depend on customers missing payments to stay in business. The impact on users who fall behind is severe. The average delinquent BNPL borrower pays $127 in fees for every $100 originally borrowed. These costs quickly spiral, especially for those who miss more than one payment or juggle several loans at once. Unlike credit cards, which charge interest over time, BNPL providers typically apply flat late fees. At first glance, a $10 fee on a $100 installment might seem manageable, but if payments are missed repeatedly, the effective cost can rival or exceed high-interest credit products. Many users don't realize how fast these charges accumulate until their debt balloons far beyond the original purchase amount. Automatic payments add another layer of risk. Most BNPL services require users to link a bank account for direct withdrawals. If the account doesn't have enough funds when a payment is due, the user not only incurs a BNPL late fee, but may also trigger a bank overdraft fee, often $35 or more per incident. For those living paycheck to paycheck, a single missed payment can set off a cascade of penalties from both the BNPL provider and their bank. Many users report multiple overdrafts in a single day when several BNPL payments hit at once, compounding their financial stress. The timing of BNPL repayments rarely aligns with how people actually get paid. Installments are usually scheduled every 2 weeks, but many workers are paid monthly or on irregular cycles. This mismatch means payments often come due when cash reserves are lowest, increasing the likelihood of missed installments and associated fees. The structure seems to maximize the chance of generating penalty revenue rather than supporting successful repayment. Younger consumers are especially exposed to these hidden costs. Those under 35 account for a disproportionate share of late fees, and many lack the financial experience or savings buffer to recover quickly. As late payments pile up, their credit scores suffer lasting damage, making it even harder to access affordable credit in the future. The psychological toll is real as well. Some users avoid checking their accounts once they fall behind, which only leads to more missed communications and additional charges. The situation is even more precarious for those using BNPL for essential expenses. LendingTree's survey found 25% of users now rely on BNPL to pay for groceries, up from 14% the year before. When these payments are missed, it's often not due to overspending, but a genuine inability to cover basic needs. The cycle of debt that follows can be particularly punishing, as there's no way to return groceries or recover funds once the purchase is made. Fee structures have become more punitive over time. The average late fee per missed payment climbed from $7 in 2022 to $10 by 2025, and some providers now charge percentage-based penalties that scale with the size of the original purchase. For larger loans, the total owed in penalties can quickly outstrip the cost of the item itself. Providers have also layered on additional charges, such as account maintenance fees after a certain period of delinquency, or collections processing fees if the account is sent to a third-party agency. These extra costs make it even harder for struggling users to catch up. The lack of transparency around these fees remains a problem. Many retailers promote BNPL at checkout by highlighting no-interest offers, while downplaying the consequences of missed payments. Consumers may not realize the risks until they are already trapped in a cycle of debt and penalties. The result is a system where missed payments are not just a personal setback, but a central part of the business model. As more consumers fall behind and face mounting fees, the financial strain doesn't stop with individuals. The ripple effects are felt further up the chain, the merchant impacting the businesses that rely on BNPL. The cost of offering buy now pay later services is dominated by the merchant fee trap, a structural issue that quietly erodes profitability, especially for small businesses. BNPL providers routinely charge merchants fees ranging from 5% to as high as 8% per transaction, far exceeding the 1.5% to 3.5% rate typical of credit card processors. For businesses operating on slim profit margins, this single line item expense is often enough to turn a sale into a loss. Merchant contracts with BNPL firms are strict. They prohibit retailers from adding surcharges or passing BNPL fees directly to customers, a practice sometimes permitted with credit card transactions. This leaves retailers with two options: absorb the full cost themselves or raise prices for everyone, regardless of payment method. Many small businesses have responded by quietly increasing their base prices by 4% to 6%, hoping to offset BNPL-related losses without deterring customers. But these price hikes can make them less competitive, especially against larger chains with more negotiating power. The impact is even more pronounced for independent retailers. While major brands might secure modest discounts on BNPL fees, small businesses typically pay the full 8% with no room for negotiation. Some report that BNPL fees now consume up to 60% of their total profit margin on affected transactions. In practical terms, a boutique with a 10% margin could see nearly all its earnings on a BNPL sale disappear before accounting for other operating expenses. For many, the numbers simply do not add up. BNPL's fee structure also creates a misalignment of incentives. Providers collect their merchant fees upfront, regardless of whether a customer ultimately repays the loan. If a shopper defaults, the retailer is left with the loss of both the merchandise and the full BNPL fee. This arrangement means BNPL companies face little direct risk from consumer defaults, while merchants shoulder the consequences. The effect is particularly damaging when defaults spike, as seen with the recent rise in grocery and essential goods purchases through BNPL. For perishable items like groceries, which cannot be resold, every defaulted transaction is a total loss. Returns and chargebacks compound the problem. If a BNPL purchase is returned, the merchant is typically still on the hook for the original fee. Some retailers estimate that labor costs for handling BNPL disputes and return processing add several more dollars per transaction, an extra burden that eats further into already thin margins. The administrative hassle of managing these cases, from updating inventory to processing refunds, only increases the hidden costs of accepting BNPL payments. The promise of higher sales volume is often used to justify these fees, but the reality is mixed. Many small businesses report that only a minority of customers truly need installment plans to complete a purchase. The majority use BNPL out of convenience. The incremental sales generated rarely compensate for the losses from high fees and increased returns. In categories like groceries, where default rates have reached 31% for BNPL transactions, the economics are even more unfavorable. Unlike discretionary goods, essentials cannot be restocked or resold, turning every default into a direct financial hit. Retailers have few tools to mitigate these losses. Contract terms often prevent them from even suggesting alternative, lower-fee payment methods at checkout. Employees are left watching as profit margins shrink with each BNPL transaction, unable to steer customers toward more sustainable options. Attempts to restrict BNPL usage through back-end controls or lower approval thresholds have had limited effect, as the fundamental problem is built into the fee model itself. Technology costs add another layer of complexity. Integrating BNPL into existing checkout systems requires software updates, staff training, and sometimes third-party support. These upfront investments can run into thousands of dollars, a significant outlay for smaller merchants who may later find that the ongoing fees make the service unsustainable. As defaults and chargebacks increase, the merchant fee trap has become a central reason why many retailers are rethinking their participation in BNPL programs. Some have already abandoned these services, while others are quietly discouraging their use despite contractual obligations. The financial pressures are mounting, and the consequences extend beyond business operations. This environment is particularly challenging for retailers serving younger, less financially secure customer segments. The next layer of risk emerges from the composition of the BNPL user base itself, where demographic factors amplify the challenges already created by the merchant fee structure. The demographic time bomb. The demographic time bomb at the center of BNPL's growth is becoming impossible to ignore. The user base skews heavily toward younger adults, with 63% of all BNPL users under the age of 35. This group generally has lower incomes and less financial experience, making them more susceptible to budget shocks and unable to absorb unexpected expenses. For these users, installment payments have shifted from being an occasional tool to a routine part of managing monthly bills. A 2025 study from the Consumer Financial Protection Bureau confirms that BNPL users are, on average, more financially vulnerable than non-users. Many who make late payments already show signs of financial distress before even taking on installment debt. Rather than providing a safety net, BNPL often deepens the challenges for people who are already struggling. This is especially true for those who lack access to traditional credit, as the data shows a clear pattern. BNPL adoption is highest in communities where conventional lending is less available. Racial disparities in BNPL usage are also pronounced. The CFPB reports that 26% of Black consumers and 24% of Hispanic consumers have used BNPL, compared to 16% of white consumers. This reflects both targeted marketing and gaps left by traditional financial institutions. While BNPL is often presented as a tool for financial inclusion, the reality is that it can lock users into cycles of debt, especially in communities already facing structural barriers to wealth accumulation. Age is a critical factor in how BNPL shapes financial lives. For people aged 18 to 24, BNPL purchases made up 28% of their total unsecured debt during the months they borrowed in 2022. Across all age groups, the average is just 17%. This means that for many young adults, installment loans are no longer a stopgap. They are the main way to cover essentials and discretionary spending alike. The normalization of installment payments at such an early stage in life may have lasting effects, as younger users are more likely to build habits around debt instead of savings. Income levels further highlight the risks. Households earning less than $75,000 a year are 4 times more likely to use BNPL than those with higher incomes. This pattern mirrors the broader trend of financially vulnerable groups turning to BNPL for everyday needs, not just big-ticket items. As a result, the people most likely to be hit hardest by fees and defaults are those with the fewest resources to recover. Gen Z's adoption of BNPL is particularly striking. According to a 2024 survey by Motley Fool Money, 58% of Gen Z respondents have used BNPL at least once. Many in this cohort see installment payments as a standard part of personal finance, rather than an exception. The combination of high usage rates and limited financial history makes this group especially exposed to the risks of debt accumulation. For those already carrying credit card balances, the average personal debt load among BNPL users is $27,400, a figure that would take years to pay down even without further borrowing. Debt stacking is most acute among younger users. Juggling multiple BNPL loans while managing other debts quickly erodes financial stability. The lack of financial cushion means that a missed paycheck, medical bill, or car repair can trigger a cascade of missed payments. As debt obligations multiply, so do the penalties and the likelihood of default. The impact of these patterns extends beyond individual financial health. When a significant share of a generation is allocating a growing portion of their disposable income to BNPL payments, the effects ripple through the broader economy. Money that might otherwise go toward building savings, investing, or funding retirement is instead diverted to servicing short-term installment debt. BNPL's marketing rarely acknowledges this demographic reality. Advertising tends to focus on aspirational purchases and financially secure shoppers, ignoring the fact that the core user base is increasingly made up of those with limited means. The gap between how these services are portrayed and who actually uses them widens as reliance on BNPL for essentials grows. The risk is not just immediate financial strain. For young adults, repeated use of BNPL and frequent late payments can undermine credit histories before they have a chance to build them. The long-term consequences, higher interest rates, difficulty securing loans, or barriers to renting housing, may not be obvious until years later. As installment payments become embedded in the financial routines of younger and more vulnerable users, the system's stability relies on those least able to weather disruptions. The consequences of missed payments and mounting debt are now starting to appear in places that will shape these users' financial futures long after the initial purchase is forgotten. The credit score impact. Recent changes in credit reporting rules have made the relationship between buy now, pay later services and credit scores much more direct, and far riskier for consumers who miss payments. Since May 2024, BNPL defaults are now included on credit reports, putting them on the same footing as missed credit card payments. This means that a single missed BNPL installment can drag a credit score down by 50 to 100 points, a drop that can move someone from good to fair credit or from fair to poor, with immediate consequences for access to future loans and the cost of borrowing. For years, BNPL loans operated outside the traditional credit system. Missed payments and defaults were invisible to lenders, and users could stack debt across multiple platforms without worrying about their credit histories. Now the landscape has shifted. BNPL providers must follow the same standards as credit cards, including reporting late payments and defaults to the major bureaus. The result is that the once hidden risks of installment debt have become highly visible and potentially damaging parts of a consumer's financial record. Consumers who use BNPL tend to be more vulnerable to these credit impacts from the start. According to the Consumer Financial Protection Bureau, 45% of BNPL originations go to borrowers with deep subprime credit, while another 16% are issued to those with subprime scores. These are individuals who already face higher borrowing costs and have less margin for error. For them, even a modest drop in credit score can mean being denied for new credit entirely or being forced to accept much higher interest rates. The effect is amplified for younger users, who have shorter credit histories and less time to recover from negative marks. The pattern of borrowing also contributes to the risk. Before turning to BNPL, consumers often show steadily rising credit card balances. Their average utilization rates are between 60% and 66%, nearly double the 34% average for non-BNPL users. This indicates that many are already stretching their budgets before taking on new installment obligations. When BNPL is layered on top of existing credit card, student loan, and personal loan debt, the risk of missing payments grows, and the consequences for credit scores multiply. The impact doesn't stop with late payments. Each new BNPL application can trigger a hard inquiry, which chips away at a credit score even if the loan is repaid on time. Multiple concurrent BNPL loans increase the overall debt load reported to credit bureaus, potentially making other lenders wary. Even positive payment history, when reported, is often outweighed by the negative effects of missed or late installments. Most BNPL providers still focus on reporting defaults rather than on-time payments, so the system is skewed toward penalizing users rather than rewarding responsible behavior. The reality for many is that the credit score hit from BNPL is both sudden and severe. Missing several payments across different providers can lead to a cumulative drop of 150 to 300 points, a setback that can take years to recover from through consistent, on-time repayment. For young adults just starting to build credit, these early missteps can block access to housing, auto loans, or even certain jobs that check credit history. The broader financial toll is substantial. High credit card utilization persists because BNPL payments eat into monthly cash flow, leaving less money to pay down other debts. This can trap users in a cycle where debt accumulates faster than it can be repaid, and every late payment further reduces financial flexibility. The decline in average credit scores among BNPL users, down 47 points since 2022, reflects this growing stress. Credit scores influence much more than just loan approvals. Insurance premiums, security deposits, and even cell phone plans are often priced based on credit. A 50-point drop can translate into hundreds of dollars in extra costs each year, far exceeding any savings from spreading out a purchase with BNPL. For those already devoting a significant portion of their disposable income to installment payments, these additional expenses can make it even harder to regain financial stability. The new reporting requirements have erased BNPL's last remaining advantage over traditional credit, its invisibility. Now that installment loans show up on credit reports, the risks are immediate and tangible. Consumers who once saw BNPL as a low-risk alternative to credit cards are discovering that the consequences of a missed payment can be just as severe or worse. This shift in how BNPL impacts credit is forcing users to confront the true cost of these interest-free purchases. With every late fee and credit ding, the line between installment loans and more traditional forms of high-cost lending is becoming harder to distinguish. The payday loan parallels. The rise of buy now, pay later services has introduced a new form of short-term borrowing that, in practice, shares many of the same risks and outcomes as payday loans. While BNPL companies promote their products as interest-free and modern alternatives to traditional credit, the reality is that late fees can translate to 20 to 30% APR when annualized, rivaling the rates found in the payday loan market. These fees often go unnoticed by users until they begin to stack up, turning what seemed like a manageable installment plan into a much more expensive obligation than the original purchase price. Both BNPL and payday lenders rely on similar revenue models, drawing a significant share of their income from penalty fees and targeting consumers who are already financially vulnerable. According to CFPB data, in 2021 and 2022, 45% of BNPL originations went to deep subprime borrowers and another 16% to subprime applicants. These are the same populations that payday lenders have long focused on. People with limited access to affordable credit, irregular incomes, and little financial cushion. The difference often lies in presentation. BNPL is marketed as a budgeting tool, while payday loans are openly labeled as emergency cash. This overlap extends to spending patterns. As more consumers use BNPL to cover essentials like groceries and utilities, the service has started to fill the same role that payday loans have traditionally occupied, a last resort for bridging gaps between paychecks. The shift from funding discretionary purchases to necessities signals that BNPL is increasingly used as a survival tool, not just a convenience. This trend is a clear marker of financial stress, and it mirrors the pressures that drive people to seek out payday advances. The structure of BNPL debt creates cycles that closely resemble the rollover trap seen with payday loans. With each missed payment, late fees accumulate, often at rates that quickly outpace the original loan amount. Some users take out new BNPL loans to cover existing ones, stacking obligations and fees in a pattern that is functionally identical to the payday loan cycle. Research shows that a sizable portion of BNPL users admit to taking on multiple loans simultaneously, a behavior that increases the risk of chronic indebtedness. Regulation has historically lagged behind both industries. Payday lenders grew rapidly by exploiting gaps in state and federal usury laws, while BNPL providers avoided many lending regulations by claiming to offer payment plans rather than loans. Only recently have authorities started to close these loopholes, introducing rules that require BNPL firms to provide clearer disclosures, cap fees, and assess borrowers' ability to repay. This regulatory convergence reflects the growing recognition that both products create similar risks for consumers. The mechanics of repayment further reinforce the parallels. BNPL payments are typically withdrawn automatically from users' bank accounts, and when funds are insufficient, overdraft fees are triggered. LendingTree found that 41% of BNPL users have experienced overdraft fees as a direct result of these automatic withdrawals, mirroring the patterns seen in payday loan collections. The combination of late fees from the lender and overdraft charges from the bank can quickly escalate a small debt into a significant financial setback. Demographic patterns underscore the similarities. Both BNPL and payday loans are used most heavily by individuals earning less than $50,000 a year, and both see higher adoption rates in communities with limited access to traditional banking services. The majority of users in each case already carry other forms of debt, compounding their vulnerability to financial shocks. While payday loans have long carried a social stigma, BNPL enjoys a more favorable reputation, thanks to its association with tech brands and seamless digital experiences. This difference in perception does little to change the underlying risks. The psychological design of both products makes them easy to underestimate. By breaking purchases into small, regular payments, BNPL, like payday loans, reduces the pain of spending and creates a false sense of affordability. Consumers often focus on the size of the next installment rather than the total cost, making it easier to accumulate obligations they cannot comfortably repay. This disconnect between perception and reality is a core driver of debt cycles in both industries. When economic conditions worsen, both BNPL and payday loan defaults rise sharply. Users who rely on these products for essential expenses are often the least able to recover from missed payments, and both sectors see spikes in delinquencies during downturns. The challenge of collecting from financially unstable borrowers is a persistent issue for both types of lenders. The business models depend on a steady stream of penalty revenue from users who struggle to repay on time. For BNPL firms, late fees now account for a substantial portion of total income, echoing the reliance of payday lenders on rollover and default charges. This creates an incentive structure where the profitability of the product depends on a certain percentage of customers falling behind. Despite the similarities, BNPL is still presented as a responsible alternative to high-cost credit, while payday loans are viewed as a last resort. This gap in perception is reinforced by marketing and the involvement of major tech companies, which has helped normalize installment debt for a wide range of consumers. As regulatory scrutiny intensifies and the true costs of BNPL become more apparent, the parallels with payday lending are increasingly difficult to ignore. The next phase of the industry's evolution is being shaped not just by financial realities, but also by the actions of technology giants seeking to redefine the boundaries of consumer credit. The tech industry connection. The rise of buy now, pay later as a mainstream payment method owes much to the tech industry's ability to weave installment plans into everyday digital transactions. Tech platforms, especially those with deep integration into users' financial lives, played a pivotal role in normalizing installment borrowing and expanding its reach far beyond the original millennial and Gen Z core. The seamless experience of splitting purchases with a few taps became a default option as companies like Apple, Google, and major fintechs embedded BNPL into their payment ecosystems. This design made installment loans feel less like formal debt and more like just another feature of digital commerce. The integration of BNPL into major tech platforms removed much of the friction historically associated with borrowing. Auto-filled payment credentials, instant approvals, and biometric authentication allowed users to take on new obligations without pausing to consider the long-term impact. Unlike traditional credit cards, which typically require a credit check and involve a more deliberate application process, BNPL was marketed as a convenience, not a financial commitment. This approach blurred the line between spending and borrowing, encouraging higher usage rates and making it easier for consumers to stack multiple loans across providers. At the same time, fintech companies began to distance themselves from pure-play BNPL models. Investor enthusiasm cooled rapidly as losses mounted and regulatory scrutiny intensified. Klarna and Affirm, once the darlings of the sector, saw valuations fall sharply. Venture capital funding for BNPL startups dropped by more than 80% from its peak, and firms that once focused exclusively on installment lending started repositioning themselves as broader financial service providers. PayPal and Square, for example, now present BNPL as a minor part of a diversified suite of offerings, rather than the centerpiece of their business. This strategic retreat is a direct response to increasing regulatory oversight. The Consumer Financial Protection Bureau's decision to classify BNPL providers as credit card issuers under the Truth in Lending Act forced tech-affiliated services to overhaul their compliance systems. Providers must now offer proper billing statements, handle chargebacks and disputes, and provide clear disclosures on repayment obligations and fees. These requirements erase the regulatory advantages that once made BNPL attractive for tech firms looking to enter financial services without the burdens of full-scale lending compliance. Tech platforms' data practices have also come under scrutiny. By leveraging vast troves of user data, these companies enabled more targeted lending and aggressive marketing. Integrations between BNPL providers and tech platforms gave lenders insight into users' spending habits and financial stress signals, allowing for more precise targeting of offers, but also raising questions about fairness and consumer protection. Critics argue that this level of data-driven personalization disproportionately exposed vulnerable users to the risks of debt accumulation and late fees. The regulatory environment continues to tighten. State-level rules have begun to mirror the CFPB's federal standards, and international regulators in the UK and Europe are considering similar moves. Tech companies now face requirements to vet BNPL partners more rigorously, provide clearer disclosures at checkout, and implement safeguards against debt stacking and overextension. The era of operating in a regulatory gray area is ending, as authorities push for transparency, accountability, and consumer protections that match those in traditional lending. For the tech industry, the fallout has been twofold. First, the easy revenue from fees and rapid adoption has given way to higher compliance costs and greater legal risk. Second, the normalization of BNPL through digital platforms has brought new groups of users into installment borrowing, many of whom are less prepared to manage the risks. As adoption spread to older and more rural demographics, default rates rose, and the financial strain intensified for both consumers and merchants. Fintech firms now emphasize financial wellness tools and budgeting features, seeking to position themselves as partners in responsible money management rather than just facilitators of instant credit. This pivot reflects a broader realization. Installment lending, when stripped of proper safeguards, cannot sustain itself as a core business line in a regulated environment. The rapid expansion of BNPL through tech platforms has created challenges that are now being addressed on a global scale. Regulatory responses are emerging in multiple markets, each shaped by local economic realities and consumer protection priorities. The next phase will see how different countries respond to the risks
global
that have surfaced in the
around
wake
the
of
world.
tech-driven installment
Governments are
lending.
moving
To address the risks that surfaced as buy now, pay later services became a staple of everyday spending. The global response is far from uniform, but three regions, Australia, the United Kingdom, and the United States, offer a clear picture of how major markets are adapting their rules to meet the challenges posed by BNPL. Australia has taken some of the most direct action. The country's new regulatory framework treats BNPL as a traditional form of credit, bringing it under the Credit Act. Providers are now required to hold a credit license and comply with responsible lending obligations. This means every BNPL transaction must be assessed for affordability before approval, and providers must operate with the same transparency and consumer protections expected of banks and credit card issuers. The shift followed a period when a significant share of BNPL loans, according to LendingTree, roughly a quarter of users, were being used for groceries and other essentials, raising concerns about debt spirals. The new rules are designed to prevent reckless lending and to ensure that installment plans do not become a backdoor to payday-style debt cycles. Early evidence suggests the changes have slowed BNPL growth and encouraged more careful borrowing, but they have also led some providers to reconsider their presence in the Australian market. The United Kingdom has opted for a slightly different path, aiming to formalize BNPL within the existing credit system rather than restrict it outright. Starting in 2026, all BNPL providers must register as credit lenders and submit to oversight by the Financial Conduct Authority. The UK's approach requires mandatory credit checks, cooling-off periods for larger purchases, and a clear process for dispute resolution. These steps mirror the protections offered to credit card users, with the goal of ensuring that consumers can access installment payments without being exposed to hidden risks or aggressive marketing. The UK's reforms were prompted by studies showing that a significant portion of BNPL users struggled to keep up with payments, especially when using the service for recurring or essential expenses. By bringing BNPL under the same regulatory umbrella as other forms of credit, the UK hopes to balance access with protection. In the United States, regulation has come in waves, with federal and state agencies taking different approaches. The Consumer Financial Protection Bureau's interpretive rule in May 2024 was a major turning point, classifying BNPL providers as credit card issuers under the Truth in Lending Act. This change means BNPL lenders must now investigate disputes, issue refunds for returns, and provide detailed billing statements. However, unlike in Australia or the UK, the US has not yet mandated credit checks for BNPL transactions. Instead, a patchwork of state-level rules has emerged. Some states, like California and New York, have imposed stricter requirements, while others maintain a lighter regulatory touch. The lack of a unified national standard has contributed to higher default rates in some regions and made it harder for both consumers and providers to navigate the system. Elsewhere, the European Union is considering caps on BNPL loan amounts to limit the risk of debt accumulation. The proposal would restrict how much consumers can borrow through installment plans, aiming to curb debt stacking and overspending. These caps would likely vary by country, reflecting differences in average incomes and economic conditions across the bloc. The EU's debate highlights the ongoing tension between making BNPL accessible and protecting consumers from the pitfalls of easy credit. What emerges from these examples is a pattern. Initial regulatory leniency allowed BNPL to expand rapidly, but rising defaults and consumer complaints have led to a tightening of standards. Mandatory credit checks, licensing requirements, limits on late fees, and clearer disclosure rules are now common features in new regulations. The days of treating BNPL as an unregulated alternative to credit cards are ending. Even with these changes, enforcement remains a challenge. Tracking loans across multiple providers, especially for small-ticket purchases, is difficult without unified reporting systems. Some consumers exploit these gaps, taking out multiple loans to bypass limits. Regulators continue to struggle with how to monitor and enforce rules in a market defined by fast-moving technology and fragmented oversight. The global trend points toward a convergence. BNPL is being brought in line with traditional credit in most major markets. What remains to be seen is how these new rules will reshape the industry's structure and the way consumers use installment payments. As these regulatory frameworks settle, the BNPL sector faces new pressures that will define its next phase. The future of BNPL. Looking ahead, the future of Buy Now Pay later will be defined by a much smaller field of providers, increased regulatory oversight, and a fundamental shift in how these services operate. The era of rapid expansion fueled by easy venture capital and unchecked growth is over. Providers now face a new reality. Profitability must come before market share, and that means making hard choices about how to sustain their business models under tighter scrutiny. Industry consolidation is already underway. The crowded field of BNPL startups is shrinking as funding dries up and defaults continue to rise. Most smaller companies lack the resources to weather prolonged losses or the regulatory expertise required to comply with new rules. Larger players are cutting costs, reducing staff, and scaling back marketing in an effort to survive. Analysts expect that only a handful of firms will remain viable in the next few years, though the exact number is uncertain. This consolidation will likely make the market less competitive and could drive up costs for both merchants and consumers. Profitability remains the central challenge for surviving BNPL companies. The original promise of interest-free installments has proven difficult to maintain as default rates climb and regulatory costs increase. Many providers now rely heavily on merchant fees and late charges to generate revenue, but these sources are under pressure. Merchants are pushing back against high fees, and regulators are capping penalties to protect consumers. To stay afloat, some providers may have to raise fees further or introduce interest charges on overdue balances. These moves risk undermining the core appeal of BNPL and could drive users to alternative payment options. Alternative models are gaining traction as traditional BNPL struggles to adapt. Card-linked installment plans, such as Citi's and Chase's recent offerings, allow consumers to split payments using existing credit card infrastructure. These programs benefit from established risk controls, better underwriting, and immediate reporting of late payments to credit bureaus. They also keep payment volume within the traditional banking system, making them more attractive to both issuers and regulators. As these options become more widely available, they are likely to compete directly with standalone BNPL services, further eroding their market share. Emerging markets continue to offer growth opportunities, but expansion comes with significant risks. In regions like Southeast Asia, Latin America, and Africa, BNPL adoption is driven by young, mobile-first populations and limited access to traditional financial products. Here, BNPL can help bridge the gap for underbanked consumers and small businesses. However, the same challenge is seen in mature markets. High default rates, reliance on late fees, and regulatory uncertainty are already surfacing. Providers must balance the goal of financial inclusion with the need for responsible lending, a task made more difficult by economic instability and varying local regulations. Technology will play a role in the next phase, but it will not resolve the structural weaknesses of the BNPL model. Advances in AI and machine learning may improve risk assessment and personalized payment plans, but they cannot eliminate the fundamental risks of lending to subprime borrowers without sufficient safeguards. The reliance on penalty fees and aggressive growth tactics has exposed the limits of the current business model. Without a shift toward sustainable practices, even the most sophisticated algorithms will only offer marginal improvements. Regulatory changes are forcing BNPL companies to operate more like traditional lenders. Requirements for licensing, credit checks, clear disclosures, and dispute resolution are becoming standard in key markets. This shift removes the regulatory arbitrage that once gave BNPL an edge and increases compliance costs across the board. Companies that survive this transition will look less like disruptive startups and more like established financial institutions, subject to the same constraints and oversight. Consumer behavior is also evolving. As awareness of the risks grows, particularly the impact on credit scores and the potential for debt stacking, users are becoming more selective about when and how they use BNPL. Retailers are reevaluating the value of offering installment plans as merchant fees and chargebacks cut into profits. The combination of changing user habits, tighter regulation, and increased competition from banks is likely to narrow the role of BNPL in the broader payments ecosystem. What happens next will depend on how well companies can adapt to these pressures. The industry's future is likely to be more focused, more regulated, and less reliant on the rapid-fire growth that defined its early years. As the dust settles, BNPL will need to prove it can function as a sustainable part of the financial landscape, rather than just another iteration of risky consumer lending. After surging to $800 billion in outstanding loans and experiencing a spike in defaults, BNPL providers now face a wave of retail exits, regulatory changes, and investor pullback that expose the model's underlying flaws. What started as a convenient, interest-free way to split purchases has instead highlighted the risks of easy credit, especially for younger and financially vulnerable consumers. BNPL must now adopt proper credit checks, clear fee disclosures, and regular reporting, steps that could transform it from a frictionless novelty into a mainstream credit product. For consumers, the lesson is clear. Convenience always comes with trade-offs, and understanding those risks is more important than ever.